least I'm enjoying the ride. At least I'm enjoying the ride. Yeah!
And now more Operation Freedom with your host, Dr. Dave Janda, on Southeast Michigan's conservative powerhouse, Wham Talk 1600. Call Dave now at 822-1600. That's 734-822-1600.
Welcome back to Operation Freedom, folks. I'm Dr. Dave Janda, broadcasting from our Freedom Bunker here at Wham Talk 1600. Podcast will be available for premium service subscribers by 9 p.m. this evening. If you missed our first half hour of the show, we had a great interview with General Tom McInerney where we discussed the Kavanaugh situation, which really was the underpinning, I believe, for the declassification event that is about to occur over the ensuing week. As you know, folks, one of the topics I tend to focus on with this show are everything associated with your financial freedom. I believe you are not being served well by CNBC, what I call CNBS, Fox Business News, the Wall Street Journal for that matter, Bloomberg or Reuters. I believe they're trying to paint you in a corner that the globalists want you to be in. One of the more valuable contacts I have is someone who is very, very familiar from the belly of the beast in the banking syndicate and the banking institutions. She goes by the name of Trader Steph. And every time she comes on this show, I am inundated with your emails and phone calls asking me to bring her back as soon as possible, and it's my honor to have her back with us today. Let me give you a little background on Trader Steph. Beginning in 1996, Steph started a career spanning 14 years within the New York City investment banking industry. She acquired a diverse skill set in human resourcing, technology and communication, training, education and development, and business analysis and global risk. She began investing in precious metals in 1999 while following market trends post-dot-com bubble and 9/11. She then left the banking industry in 2009 after 5 years in global risk management at Citigroup. Trader Steph developed and now hosts a live Precious Hour webinar specializing gold, silver, and the mining equities combined with research of industry fundamentals, financial markets, global news events, geopolitics, and monetary policy, otherwise known as fusion analysis. Folks, you need to follow Steph. And here's the best way. You can follow her at Trader Steph at Twitter, and she publishes articles on a regular basis at a great website, crushthestreet.com. Crushthestreet.com. She just put a featured article up in the past 3 days that's absolutely fantastic as it relates to the gold and silver market. Steph, welcome back to Operation Freedom.
Hey, Dr. Janda, how are you today?
Oh, I'm doing great, Steph. Hey, Steph, I want to run something by you. There's, I think, and you can tell me if I'm wrong on this, but a large financial event that occurred this week, in particular, this past week, in regards to the bond market.
Oh, yeah.
And you know, the Stuart Varneys and the Maria Bartiromos and the good old boys at CNBS, they just pretty much went without a mention. But the rise of interest rates in the bond market was, in my mind, take your breath away. Zero Hedge just put an article out, waiting for the world to end. Bond rout bodes badly for exuberant equity investors. Here's what they say, and I'd like your take on it, Steph. It was a tough week for stock market investors, but the primary driver of the chaotic crumble in small caps and tech stocks was not one of the usual suspects. Even for those who consider themselves hedged or balanced, it was the worst week in 7 months. The blame for this blight on Americans' wealth was placed squarely on the shoulders of the bond market and its violent and high-velocity lurch higher in yields. Yields rose across the curve on the back of strong U.S. economic data and hawkish comments from Federal Reserve Chairman Powell, forcing equity investors to reevaluate the higher rate environment. Your take, Steph?
I'm not very concerned about it because The long-term trend line going back 20, 30 years has been breached, but it's not decisive. And the fundamentals, the underlying fundamentals on the economy are not as great as CNBS is reporting. And what the listeners have to keep in mind, as these interest rates go up, and the reason they went up, sometimes you get bond vigilantes, which things kind of happen aside from what the Fed does. But overall, the Fed's been raising rates since December 2015, right?
Mm-hmm.
That's a problem because there's all these U.S. dollars in emerging markets overseas sloshing around that was loaned to them. Now it's costing them a lot more money to pay us back, which is why you're seeing a lot of chaos on top of the sanctions and the tariffs. So it's more of a knee-jerk reaction as far as I'm concerned, and you're seeing a lot of algorithmic, computer, mindless algorithms trading. So I don't see if there's any major concern yet. We start getting up into 3.5%, 4%, and it runs away, then I'll get worried. Until that time, I'm not so concerned. And I do manage families' retirement funds, and we're still long bonds.
So when I look at a 10-year yield that goes from, 3.02 to 3.24, 3.25, I mean, to me, that's a big jump in a short amount of time.
In the near term, yeah, it looks big, but in the bigger picture, it's not.
Got it. So let's talk. You wrote an article this week as it relates to the gold and silver market, the precious metals markets. Educate our listeners on that because you have great charting, great analysis. Bring all of our listeners up to speed on that.
Sure. With the price movement in gold, I'll get to that toward the end of our segment with chart explanation. But the saving grace for precious metals is that it retains your capital. Right? Mm-hmm. So, since December 2015, since when the Fed started raising rates, by the way, we're up 15%. So that's 3 years, so that's a return of 5% a year, despite the pullback since January and February. It's actually not too bad. 5% return is the advice you give someone when they have some money and you tell them what to do with it. Buy a house, pay it off, get a cheap Japanese car in the driveway with a 25-year roof, and take 5% on your investments to live off of for the rest of your life. That means don't mess with me. Mm-hmm. So 5% really isn't that bad. So back to precious metals. So it's saving grace amongst all this chaos that you see out there in the financial publishing world, is that it retains its capital long-term, not just short-term. So the article is at Crush the Street. It's the most recent article that I published, and I'll just touch on a few points. If we look at the price of gold back in the 1950s, it was priced at $35 an ounce, right? Correct. If we look at a few products that typical American households purchased back then, a postage stamp was 3 cents. A 12-ounce glass of Coca-Cola at the local 5 and dime was 10 cents. The subway ride in New York City was 10 cents. A loaf of bread was 14. A gallon of gas was 20 cents. Sirloin steak was 77 cents a pound. A second-tier seat at Yankee Stadium was $1.25. A 62-square-inch television, the Philco model, which was really popular, you could get on sale for $199. That's $199. And the average price for a Ford automobile was $18. And a middle-class home was around $7,100. Now, a men's business suit, let's visualize this. You got that 35 U.S. Federal Reserve notes in your left hand, and you got an ounce of gold in your right hand. That ounce of gold was valued at $35 an ounce back in the 1950s. Mm-hmm. That men's business suit would cost you about $35 to $45. Now, that same 35 Federal Reserve notes is not going to buy you a business suit. Mm-hmm. Matter of fact, it won't even buy you a really well-made dress shirt. But that ounce of gold in your other hand, it'll buy you a really nice, high-end, fitted wool suit at Lord & Taylor. Plus, you could still buy the tie and the shirt, maybe even a hat. But that depends on the gold that you have. Or you got paper gold that you're trading. Do you have something that's standard mintage from a mint, or you got a numismatic coin? So that value can vary. So basically, gold's at $1,200 an ounce today in the paper playpen. Not bad. Matter of fact, you could buy 2, 3, maybe 4 lower end business suits with that ounce of gold. But that $35, not even going to buy you a dress shirt. Mm-hmm. Isn't that horrible? So now silver, same deal. The denarius was the coin during the Roman Empire. It was 90% silver, kind of like the junk silver that we had for change up until 1964. Mm-hmm. But it was devalued through its lifetime. But that would buy you a loaf of bread back then, or 2. Now, if you take 1/10 of an ounce of silver, and that's $1.50 at $15 an ounce, that will still buy you a loaf of bread today. Now, if we look at the United States quarter that's pre-1965, otherwise known as junk silver, that quarter will buy you 1 or 2 fresh-baked loaves of bread at the Walmart Supercenter bakery. Maybe even buy you a brand name off the shelf at your favorite grocery store. Now, that quarter will also get you a gallon of gas to go buy that bread today. Not bad.
Not bad at all.
No.
So when you look at your, you mentioned your charts. So you have a number of charts in your writings. What are they telling you? Because one of the things I've found, Steph, is that your analysis of your charting techniques is far and above anything or anyone that I'm aware of. Which actually gets me into another issue. How frustrated? Right? How frustrated you must be, because a lot of these folks that are featured about their charting analysis, even on Zero Hedge and on a number of these sites, it's almost, and tell me if I'm wrong, but it's kind of like an all-boys network. And the person that I have found to be the best at this charting analysis, I don't see him quoting you. Other than I noticed Rickards on Twitter in the past 24 hours gave you a shout-out.
Yeah, that was very nice of him, huh? That was great. Yeah, and actually my articles get posted up on Silver Doctors. They're about to be posted now up on Seeking Alpha. So they're starting to, get thrown around out there. But I was looking at this one comment earlier, and the comment to the article was, well, let me tell you something, girly. Look, I don't want to go down the sexist, rat hole here, but it's still out there. It's still out there. And as far as technical analysis, everyone can look at a chart and we can see 2 different things, just like 2 people witnessed the same exact accident from the same position, and they've got 2 completely different perspectives. So, there's trading styles involved here and lots of different information and people's experience background, how long they've been doing it. So there's a lot of variables here. So if folks are attracted to the variables that I kind of throw together in an analysis and that works for them, hey, that's great. Give me a follow.
Mm-hmm. So let's talk about some of your most recent analysis and charting. What are they telling you as it relates to gold and silver?
Sure. Well, the 2 previous articles I did Smart Money, Ace Up the Sleeve, part 1 and part 2.
Right.
And what was going on back in the summer was that I noticed that the commercials, who are the bullion banks, they began to go long on their paper positions. And the hedge funds, or the large specs, which is generally what the mainstream media, financial media talks about. Oh, the large specs are either long or they're short. What are the commercials doing? Because those are the folks who are closest to the physical that's in the vaults or what's going on in the paper markets, whether it be the Conmex or the LBMA. And the commercials started going long. Now, interestingly enough, when you look at a very long-term chart, the last time the commercials went long was back in the late 90s. And that's when the bull market in gold got its legs and its giddy-up going on again. Mm-hmm. So the price was a lot lower. We were down below $300 an ounce. So we're in a position right now where the fundamentals are 100 times better than they were then. Heck, we hadn't even had 9/11 yet at that point. It's a big deal. So now the commercials are long. And the hedge funds are still some of their longest, not their longest, but their most short positions ever. So it's just, some of it's just crazy algorithms. This is just not people, making decisions. But keep in mind, back in the late 90s, the algorithms were not as dominant as they are now. So that's changed the whole game, which in my recent article, if you go read it, anybody out there, there's an interview with Stanley Druckenmiller, and he discussed how the algos have completely thrown his investing style in the things, the variables he used to look at, like out the window. It's just nothing makes any sense anymore. So short term, yeah. Long term, yeah. Medium term, you just really can't be sure. So back to that gold chart with the commercials and the hedge funds and the large specs, that's known as the commitments of traders report. So on my next analysis that I publish, I'm going to put another chart out there, but we've been bouncing along since around August, and just when we got that huge volume pop back earlier in the year, I was like, hey, it's going to go one way or the other. We're bumping up against that, 1380 again, but it went down instead. But where we are now, we've been chopping for several months, and when you compare, if we look at the weekly chart, I put out a notice on my Smart Money. We're looking at 1210. We keep banging up against that 1210, and I warned that 1210 looks like a lateral for a bear trap. And what do I mean when I say a bear trap? It means when the price suddenly goes below a specific level, that happens to be a Fibonacci level, and then it bounces around, or it immediately pivots back. It can go either way, but it kind of creates a little bucket. And that's kind of like what it's doing right now. It's creating this little bucket. So that 1210 may be the lateral of a bear trap, and I put that warning out there. Now, when we look at the weekly chart, some of the variables on this chart are way in the oversold area, while some that are reaching that are now beginning to roll over, and they're starting to look positive. Also, the volume is beginning to rise again on the weekly while we're at the lower price point. Now, if we drill down into a daily chart, you see it chopping sideways, but the last 4 days the volume has been falling off. I don't like that. But the other indicators are beginning to turn to the positive trend, to the upside. So it's kind of like, yeah, maybe, maybe not. But at the end of this chop that we've had since we put the low in mid-August, when I called that on a chart on Twitter, I didn't say that was the absolute low, but there was this huge volume buy that came in, would just completely blow you away. Once you think you've seen volume spikes, then that came along in mid-August. We got a little flag and a pennant. And then this past week, on drilling down to the hourly charts, we had a little cup and handle, and we broke out of a longer-term trend line. Now, back to that daily on the gold, there's this thing called the 50-day moving average. I'm going to compare this to copper, because anyone out there that's a trader and has access to charts and know what I'm talking about, if you look at the trend in copper, let's just go back to December of 2015. They're not tight, but they do correlate. And copper has gotten a little run lately, but it's been oversold. Stanley Druckenmiller actually touched on that. Also, there's another interview within my most recent article that touches on that as well. But copper has broken over the 50 on the daily, and it's been chopping for about a week. The gold chart has been banging up against the 50 and hasn't broken past it on the daily. So we've got a pretty good chance that this breakout of the cup and handle, which took out the 50 on the hourly, could be the beginnings of the end of the downtrend that we've been in since January, February.
So your technical analysis tells us that the folks that have been so frustrated, including yours truly, about how the pricing, if you will, and the pricing of their real money, that being gold and silver, has been occurring over the past several months. It appears, based on your analysis, that our frustrations might be coming to an end in the not-so-distant future.
Yes, and I'm also hearing some whispers there's been talk for a few years about a global currency reset.
Now, let's talk about that, because many people believe that's conspiracy theory, and that's never going to happen.
It's not. It's happened multiple times throughout monetary history. Mm-hmm. It eventually has to happen. It always does. When, how, for what reason, the terms, what day, who knows? But I'm seeing a lot of chatter, and not from tinfoil wearing hat folks, but from reliable sources. Something may be down the pike at an exit that is a lot sooner than most of us may think.
So how would that look, Steph? Tell me how that a global monetary reset looks.
Oh God, who knows? One thing's for sure, it won't be a 1971 Nixon event. It'll be a lot different. Here's my suggestion, and this suggestion is not just because of what we're talking about, because I think everyone should take these measures no matter what, just for good reason. Back in the 20s, 30s, 40s, whatever, pre-Depression, folks always kept extra food in the pantry. They had cash in the house, maybe some gold, maybe some silver coins. You need to be prepared if the banks should have to close for a few days, kind of sort things out. But the basis of this next reset actually may be the dollar going back to being backed by gold. At some percentage point, we don't know what that would be. Yeah, it could be interesting. It could be interesting.
So if the dollar all of a sudden is backed a certain percent by gold, in your estimation, what would happen to the following markets? Stock market, bond market, real estate market, precious metals markets?
I don't know. Because now we have, I could tell you what they're supposed to do.
So what are they supposed to
do? If you listen to Stan Druckenmiller, he's one of the best out there. He's kind of like, I don't know what's going on right now. Nothing makes any sense.
Right.
The guy was managing, let me look at, $12 billion. Used to run the Soros Fund for a couple of years. It's as apple pie as you're going to get when it comes to a great trader, investor. It depends on what the algorithms are going to do. Because the algorithms are going to read the headlines too, but they're going to be making mindless decisions.
Right.
Although, one thing's for sure, that a revaluation, some kind of a currency reset, whether this is going to have something to do with the IMF or not, I think there may be a new global reserve currency that won't be the dollar, but the dollar in the United States would be backed by gold. Whether or not the global reserve currency would be backed by a hard asset via the IMF, say, is a possibility, but I'm just not too sure about that. I honestly don't have the answer. But it would happen on a weekend, just like when a bank closes on a Friday night after the market closes. And then, the bank doesn't open on Monday, but it'll happen on a weekend, whatever happens. And there could be some event that precipitates it, that we're forced into it. Well, I think there's a lot more going on that meets the eye that really nobody knows, and that's how these things work.
And 2 days ago, Steph, the IMF came out and said the world economy, you mentioned them, the world economy is at risk of another financial meltdown following the failure of governments and regulators to push through all the reforms needed to protect the system from reckless behavior. Steph, how can folks follow you because they need to follow you?
Head on over to Twitter, Trader Steph, TraderStef, like Francis, or go over to crushthestreet.com, and you can see my articles under the moniker Trader Steph.
Steph, I'd like to thank you for everything you have done, are doing, and will do. You're an incredible and very valuable resource when it comes to folks' financial freedom. Folks, you're listening to Operation Freedom. Dr. Dave Janda broadcasting from our Freedom Bunker here at Wham Talk 1600.